fifth piece of that puzzle that we leave out as part of the 4-week curriculum because there's not always a 5 weeks, a fifth week in a given month. Nonetheless, as we take a look, options pricing will be our opportunity to share with you this month and today specifically. But it also happens to be that options pricing is the first of our options intermediate course. So if you are one who's thought about looking into some of our 4-week courses, they're available to you at no charge, just like this class that you are in today. And they can be located at fidelity.com/classroom. Fidelity.com/classroom is the website, and it looks like this. Here's fidelity.com/classroom. When you pull that up and just scroll down a little ways, we'll find the options for beginners course, which will give you everything leading up until this class we're talking about today. Or options intermediate, which begins with, we go ahead and click learn more and register. It begins with the options pricing discussion. Now, for those of you who are interested in any of these classes, now you have that resource, fidelity.com/classroom. But I brought you here for a second reason as well. And that's because right here on fidelity.com/classroom, then options intermediate, here is a copy of these slides. So if you're one who likes to keep a copy of these, maybe make some notes on them, even print them out and keep them, feel free to do so. You can get a copy of them right here. When you click this link, however, it is all 4 weeks worth of curriculum. So do know you're going to get 100 slides or so all together. We won't be going over nearly that many all in our discussion today, but nonetheless, that will get you well prepared and ready to go. As I glanced through some of the notes that people have sent in saying what they were looking about, definitely some of the mechanics, Sonia, we're going to be talking about in depth. Robert, talking about volatility in the Greeks, absolutely. That's going to come to light here. And for you that said that you haven't traded options before, we will make sure that we try and answer any questions you send in. But now you know there is some other material that you could go to if this feels a little bit deep in its context for you as a brand new beginner. So let's go ahead and dive into the material. I'm going to take us just a hair further here, Troy, and then I'll pass the mic over to you to launch us into the next topics. But here's where we're going to start out, folks. Options began trading over the course of the last 100 years or so, mostly in unique settings, high dollar amounts, and they weren't very convenient in the beginnings. But over the course of the last 30 or 40 years, they have become more and more widely accepted and broadly used to the point that you and I, as simple retail traders, can go ahead and take advantage of options to enhance our yields, to protect our portfolios from certain types of risk, or even to speculate in the market. So we have a lot of flexibility available. As we go ahead and jump into this, I want to explain a little bit how this comes to light. The way this works is that an options model was developed by Misters Black and Scholes, were the two who first came up with it. And as a result, you may have heard of the Black-Scholes options pricing model. If you have, great. If you haven't, even better. Frankly, folks, we don't need to understand the ins and outs of the model. In fact, describing it is what earned Misters Black and Scholes and Merton the Nobel Prize in mathematics. So amazing work, far beyond my own personal comprehension to derive those things. But we're going to talk about how we actually apply some of those things. You don't need to know how to create a calculator in order to use one to do 2 + 2. Same is true here. Even though there's very advanced computing and calculations done behind the scenes, the actual output is relatively understandable. As long as you've got a good teacher like Troy and myself, we'll attempt to be here for you to make this clear. But there are a few factors involved in options prices, and that's what we've listed here as these option pricing factors. The stock price, for example, is it a $1,000 stock price? Is it a $10 stock price? That's going to make a difference in the relative value of the options. Which specific strike price is this? Meaning, which of those strike prices is it? Is it the $15 strike price on your $10 stock? Or is it the $5 strike price? They will have a dramatic price difference based upon where you could potentially execute the stock trade if you were to exercise the option. Time to expiration. How long is this theoretical coupon to buy or sell shares good for? When does it expire? The more time involved, the more value there will be. Interest rates, dividends, and volatility also are part of this model. We're going to talk at length about these first several, as well as volatility today. But it's important that we understand that these are the pieces that we would plug in order to determine what? We would plug those into the options pricing model in order to calculate the theoretical price of an option. That sounds very advanced and interesting and maybe worthwhile. But the reality is, when you and I go and look at an option, you don't need to calculate a theoretical price because the real price is right there in front of you. The bid and the ask. You can even look at the last traded price. You know the actual price. But thanks to arithmetic, we may all understand that using some algebra, we could switch out this one, which we already know, and solve for any of these up here that we do not know. Most importantly, the volatility term. Volatility is kind of this X factor in options pricing. And at the start of an options trade, if you're looking at the current value of an option, you don't need to calculate its theoretical value. Rather, you're looking at calculating what is the current volatility implied by the price that you view currently in the options trading world. All of these other factors are known. Volatility is that X factor, the squishiness of the options price that tells us what else is going on here. However, if we are going to forecast into the future and say, what would my option be worth? For example, if the stock were to jump by 10%, if bad news comes out and it drops by 30%, what would happen if nothing changes about the stock? It sits right where it is, but time passes. We go from today straight out to next week and on into July. Well, how will that impact my options trade? All of those are part of our considerations. But in order to do that theoretical price calculation of something in the future, well, now you're going to need all 6 of these pieces to plug in. Again, most notably, you will have to provide a volatility assumption as a variable in your calculation. And we'll show you how Fidelity's tools can make this work for you. But this is what you need to understand about the options pricing model and options prices. These are the pieces that we would need in order to say what the price might be. Now, I'm often asked, well, how accurate are these pricing models? Well, they're perfectly accurate, folks, 100% accurate. Just like your calculator is 100% accurate. It always tells you 4 if you ask 2 plus 2. But if you accidentally fat finger it and push 2 plus 3 or 2 minus 2, you will get a different answer. The calculator didn't make a mistake, but often the human may make a mistake. When we think about these pricing models, they tell us what would the option be worth if something happens. Well, that is a clear factor. But if we were inaccurate in our what if scenario, well, that would change a lot, wouldn't it? How long would it take me to drive from here to there? Well, it depends how fast you go. It depends which route you go. It depends. Did you fill up with gas before? Are you going to have to stop along the way? Are you actually driving a car or are you riding a bike? All of these things are going to take a dramatic change to the actual equation. So with that, Troy, is kind of our backdrop. As for options pricing and where these values come from, maybe you can start give us an intuitive feel for what happens with options prices at different periods in the options world.
Yeah, Jake, good to be with you today. Good afternoon, everyone. It's always good to talk about option pricing. We want to really understand the mechanisms. And again, for those of you who are newer, brand new, we are kind of assuming you've had some of the basics, right? What is a call? What is a put? Usually, this is a class or this is a session that's at the beginning or the starting of our intermediate level class. So again, we ideally want to know already what's a call, what's a put, and some of these very basics, but we want to really understand the mechanics. So I really like that comment from Sonia there about understanding mechanics, understanding some of the intricate pricing aspects of options. So it's a little bit more intermediate, but again, even from a beginning perspective, even from very simple strategies, this information should be helpful for you. So Jake, I'm going to go a little bit out of order here. Let me start with just a very kind of basic breakdown here. At the end of the day, options have two main components to their pricing. They may have an intrinsic value portion, and all options leading up to expiration will have some amount of extrinsic value. And so this extrinsic value is really what we're going to try to understand. The intrinsic is built in. It's there. It's either there or it's not. So when we look at an option contract, an option that is in the money has intrinsic value. For a call option, this means our strike price is under the current fair market value. For a put option, that means our strike price is above our current trading price. Let me say that one more time. Intrinsic value for call options is when our strike price is below the current trading price of the underlying, and when a put is the strike is above the current price of the underlying. So for example, if we own a call, we have the right to buy it at a lower than fair market value. So there's built in almost like equity, right? When you think of a mortgage, right? Let's say you own a home, let's say it's worth $200,000. If you have a mortgage of $50,000, your equity, your built-in value is 150 $1,000, right? That extra value you own through or you owe through your mortgage. So it's the same thing with an option premium, right? Some options will have built-in value, which is intrinsic value, and that extra value, we call that extrinsic value. We might also call that time value. And this is going to be the implied volatility aspect, which we're going to break down further. We're going to kind of look at there's three main factors that really affect an options price. They're going to be the main drivers. As Jake showed us, there's these theoretical formulas that really kind of helped us understand in theory how an option should behave. But again, there's going to be three main aspects that are really going to be the main drivers of an options price. So when we look at an option, we should understand, is there intrinsic value? Is it in the money or is it not in the money? As we'll see soon, options will behave differently if they're in the money, at the money, out of the money, because they'll have different exposures. And we're going to talk about Greeks, and Greeks, again, are going to help us understand how an option should behave under certain circumstances. So, for example, if we're looking at a stock that's trading at $100 per share, if we see a call option that's $95 strike, it has built-in value. It's worth at least $5, right? Because you're buying it $5 below its current market price. Well, it's not going to trade at $5. It's going to trade 5 plus some extrinsic value, and that's going to be based on some other factors that we'll look at: time to expiration, implied volatility, and some other factors as well. Now, if we're looking at that same stock that trades at $100 per share, we'll call it XYZ stock. If we look at a 105 strike call, it has no intrinsic value because you're looking to potentially have the right to buy at an above market value. So all of its value is going to be extrinsic, meaning it's not built-in value. It's based on time value, implied volatility, et cetera, et cetera. So let's dig into this a little bit deeper. So Jake, you showed us one of these slides. Let me just kind of repeat a little bit here just to kind of bring us up to speed. So what affects an options value? So with a stock, when we buy a stock, we have some embedded expectation. Again, if I'm talking about XYZ stock trading at 100, well, if I believe that XYZ stock should be valued at 95, I'm not going to buy it at 100. I'm not going to buy it at 95 because that's where I believe it is. If I buy a stock at 100, I should have some belief or expectation that at some point in the future, that stock should be worth more. I'm looking to get a return on my investment. I don't want to lose money, right? So with options, options trade on an expectation of the future, right? There's always going to be something. If you say, well, how high could a stock go between now, 2 weeks, now and a month? No one's going to say, I don't think it's going to go higher at all. Well, it could go high. It could go higher by this much. It could go higher by that much. And so that volatility component is going to affect that call pricing. Also, how much could a stock potentially go down? That's going to affect put pricing. So when we have a higher expectation, so when our expectation changes, stock owners tend to get nervous. They can buy puts for protection. We can also just buy puts for speculation in terms of if we're expecting significant downside. So when we buy options, just like with stocks, right? There's buyers and sellers of options. When there's a more aggressive buyers of options, that's going to raise the price of an options contract. That options contract will increase in value. So when an option price goes up, we say there's higher implied volatility levels. That basically means the expectation for how volatile a stock could be in the future has gone up. So if I'm looking at, again, XYZ stock is at $100 a share. If I'm looking at the 105 strike call, let's say that call was trading at $2. That means between now and expiration, the market expected, hey, this could go as high as $107. That's 105 plus $2. If suddenly that $2 that contract, that 105 strike is trading for $2, what happens if it starts trading at $5? It more than doubled. So that means owners are expecting, hey, this stock could go as high as 110, which is 105 plus the options premium. So again, it has no built-in or intrinsic value. It's trading purely on the expectation of the future. So when option prices go up, we say implied volatility is going up. Implied volatility is a measure we use to gauge the supply and demand of an option. The higher the implied volatility, again, the market's expecting a greater movement between now and time to expiration. Conversely, or inversely, I should say, if we think, okay, maybe we think the stock's not going to move as much between now and time to expiration. Well, what would we do to options? We would be a net seller of options. We think the options premium is too high. We think it should be lower. So if we own an option contract, we would sell it. Perhaps we could also sell to open if we're doing a different strategy, like a covered call, or we're doing a cash secured put sale. And often when people net sell options, they're selling it for income. They're receiving the proceeds of the contract with the expectation I'm likely not going to have to be assigned or obligated to perform my duty, or if I am, I'm okay with that. So, for example, if we look at, again, I'm going to use that same example, XYZ stock trading at 100. Let's say we don't think it's going to go much higher, and we see that 105 option trading at $5. Well, if we don't think it's going to go up to 105, we might sell that, collect $5. If that stock does not ever go to 105, and if anything, if actually it goes down, that 105 contract at expiration is worth nothing. So we could either buy to close before expiration, or that contract could expire worthless, and we collect $5 per share worth of premium. That could be very attractive for many of us, depending on our outlook, depending on our strategy. Whereas again, let's say the stock went up more than that, the option price could still go up. If we were a seller, we would actually be on the losing side of that trade. So what we're going to do is, again, two main components, intrinsic, extrinsic value. That extrinsic portion is going to be that time value, that implied volatility. Don't let that phrase implied volatility scare you. For a lot of newcomers, that's one of the harder aspects of options to typically wrap your mind around. The idea is, again, an option contract trades based on the expectation of what the future could hold. If the implied volatility is higher or goes higher, that means the expectation has changed. And sometimes expectations can change for a variety of reasons without the stock even moving. Of course, the stock can move. So that's stock's price, the expectation or implied volatility could change. And then the third factor is time. So let's look at these factors and let's break them down a little bit more. Three main factors that affect an options price. It's going to be what actually happens to the stock between now and time to expiration. There is time. So time is a constant. We can't change time. We haven't discovered a time machine as of yet, or at least I haven't. I know, Jake, I don't believe you have either. So time is a constant. And if we are sellers, time is working for us. If we are a buyer of options, time is working against us. If we are a buyer, we want the expectation to change in our favor. We typically want the expectation for volatility to increase. Or if we're long a call, we want the stock price to increase. Either, maybe even both would actually help our trade. Time is going to work against us because our trade has a definitive date and time. We have a date of maturity. And so if we don't get the stock movement in our favor, if we don't get a favorable change to implied volatility or that future expectation, our trade won't work out. Whereas if we're a seller, if we sell an option, time is working for us. The buyer wants the movement, the buyer wants the increase in volatility. The seller says if nothing happens and the expectation goes down, that option loses value. And if that keeps happening between now and expiration, that contract is worth less or potentially worth nothing, which is what the seller ideally wants. So again, the three main drivers, and actually there's a tool in Active Trader Pro that can help us model out these scenarios. If we have time, perhaps we can touch on it today. But again, people might ask, what about changes to interest rates? Or what about all these other factors? There are many other factors that do affect options. But again, these are going to be the three main drivers. So when you're planning an option trade, think about what do you expect in terms of the stock movement? Do you expect the implied volatility? Do you expect the expectation to increase for how volatile a stock could be? And how fast or what's your time frame for this outlook? Is this going to be 2 weeks, 2 days, 2 months? And again, that's going to affect our trade. And when we model out scenarios, we can say, all right, maybe we get a mix of these outcomes. Maybe we get the stock moves against us, but maybe the expectation goes in our favor. Maybe the expectation goes out of our favor, but maybe the stock moves in our favor. In different scenarios, depending on what kind of option we're trading, we can see and we can understand different scenarios where a trade can work out in our favor or can start working against us. So, Jake, why don't we take a look at a deeper dive at these three main factors and look at how they affect options and their corresponding Greeks that can help us understand, again, these aspects more.
Yeah, I totally agree, Troy. The first one we're going to dive in and take a look at is the stock's price. There's an easy way to start to understand this. When stocks move, they move by a percentage, but the real determination is dollars, right? And if there was a $1,000 stock, and let's pretend that it moved up by $10. Well, using a little bit of mental math, $10 on a $1,000 stock, that would be 1%, right? It would have moved up by 1% or maybe down by 1%, but it moved by $10. 1%. That's not a terribly large move. The stock market has gone up and down by 1% in the last couple of weeks. That's a very reasonable thing for it to occur. However, if we glance over here at our comparison, a $5 price tag stock, and yes, $5 stocks do exist, so do $1,000 stocks, but let's pretend our $5 stock also went up by $10. In percentage terms, that would mean it tripled in value from yesterday to today. That, folks, does not happen on a regular basis, at least not across most stocks. And what about the antithesis? What if it went down by $10? It can't. It hits zero. That's an impossibility. It could hit zero theoretically, but can't go to -5. That's impossible. So we certainly see that the actual price of the stock is important in terms of how much a movement would be. And since option prices are based on the dollar movements of those stocks, you would expect a $1,000 stock to certainly have a larger cost than the $5 stock just based on the pure size of the stock. But it's also important to note what's normal for this stock. What about the $1,000 stock? Does it usually move in much bigger swings or smaller swings? What if 1% for this one is a rarity? It usually only moves by 0.25% per day. Whereas this $5 stock might move by 3 or 4 or 5% every day, up, down, or sideways. It may move in big swings. Those are also going to have impacts on the options price. But first, let's think about just that stock price and stock price alone. Let's start with that dollar price, and that's pretty intuitive. We can kind of all understand where that comes from. But there's a second and related idea to this, and that's based on how far the stock price might move. And we use this borrowing a term from mathematics of delta. Delta means the difference between two things. Maybe you've heard that in other equations as well. Delta is going to talk about the difference in two things. But here, delta starts with D, and we're going to think of it as direction. Delta, direction. If we are thinking about delta, we're talking which direction did the stock price move? And based on which direction it moved, will that help or will that hurt my options trade? There's some wordy explanations here on the left-hand side. I think the example really locks it in for us. Suppose you were to look at a long call and it happened to have a delta that measured 0.5. That delta would mean that if the stock goes up by $1, you would expect the options price to go up by about 50 cents. If the stock had instead gone up by $2, you'd expect it to go up by approximately $1, about half or 0.5 of the stock's price move. Why do we use $1 in the example? Well, it turns out that's precisely the amount delta is meant to measure. It's a $1 move in the stock's price is what's going to determine this value. But again, then we think about how else we could accomplish this. If the stock was to move by $1 and we only get 50 cents worth of move, well, there is another way for us to get that 50 cents worth of profit or loss if the move is in the wrong direction. And that would be by owning shares. Let's suppose you owned 100 shares of stock and the stock went up by $1. Well, you would make $100. That part's pretty easy, right? $1 for each one stock. But with options, that's the harder piece, because an option does not move up by $1 just because the stock moved up by $1. It will instead move up by delta, in this case, 50 cents. So if you have one option, which remember, one option tends to represent 100 shares of the underlying stock, if that $1 move in the stock was translated to a 50-cent increase on our option, and we multiply by 100 in order to determine how much gain or loss that would cause to us, well, that would be a 50-cent change to the options premium or a $50 change to our account balance based upon each contract that we happen to own. That change is going to represent a gain for us. But if we were to instead own 50 shares of the stock, we also would have earned $50, right? 50 times our $1 per share. There's another way for us to do that. So that's what they call share equivalency. One option with a 50 delta has about the same exposure or profit potential for that next $1 of movement as 50 shares of the underlying stock. And you could also look at this as an approximation of probability. You could say that it has about a 50% chance of being either in or out of the money at expiration. Troy just gave us a rundown of what in and out of the money are, but we could think of that as whether or not it would make sense for us to transition into stock at the end of the option's lifespan if we didn't want to end the trade. All told, this tells us that delta has a number of different valuable implications for our analysis. It can tell us how much the stock's movement will translate into a movement in our options price. It tells us how many shares it acts like, and it gives us a glimpse at the probabilities related to our current trade. So delta gives us a lot of information all at once. And here, I think I'm going to deviate from the script for a moment, Troy, and show the folks how we can access this in our trading tool. So here I've got Fidelity's Active Trader Pro open, and it's just a blank canvas to start with. If you're unfamiliar with this platform, folks, as an options trader, I strongly recommend you download it. It is free, and you can access it at fidelity.com/ATP for Active Trader Pro. Go ahead and download it for your desktop or laptop computer. When I go ahead and pull up my options chain, and let's suppose we take a look at a symbol. Apple has been doing it rather well over the course of the last week. Why don't we take a look at it? It's up almost 2% today. And when we grab, for example, the July 19th expiration, we can see that our options chain gives us all sorts of details. Probably, if you've been trading options at all up until now, you've looked at an option chain at least a few times. But you may or may not have known that the different columns presented to you are actually customizable. You will notice that I have a column labeled Delta right here on the options chain. If you do, then great, follow along. If you do not, go ahead and right-click up here, and you can add additional columns. For example, there's a whole list of Greek-sounding names, including Gamma, Vega, Theta, Rho. All of these are other options-related ideas. I'll go ahead and add in here Theta, for example. And you'll see that now I've got a column on both the call side of the equation and the put side of the options chain, showing both delta and theta. Now we have our values showing up and populating, helping us understand. And it looks like this 195 call has currently a 92 delta. In other words, there's about a 92% chance that the stock stays at or above 195 through the expiration. That's that probability type look. Or if the stock goes up by $1, you would expect this option to change by about 92 cents, acting like about 92 shares. That's the share equivalency. Very different if we instead look at the 240 strike price option, which has a delta of just 10. And you'll notice that when I read these, I don't say 0.10, just 10. That's how we read this, accounting for the 100 multiple in options. So our 10 delta call means that if the stock was to somehow make it over 240 by July 19th, that represents only about a 10% probability. It would be a pretty impressive move for that to occur. Do you remember what I said previously about determining the options price based upon that model and that we had to make some assumptions? There is an important assumption involved here, and that assumption is that the implied volatility remains about the same. In other words, currently, option traders are forecasting a 25% volatility. This number represents an annualized number that we don't need to think about, but the important part is saying that there's a 10% chance of the stock getting to and holding above 240 by expiration is relying upon this implied volatility that currently exists in the contract. So make sure that you always bring that full circle. You can't say that a coin flip is 50-50 until you know that it's a fair coin. If I have a weighted dice and I roll it, it's not a 1 in 6 chance. Now it's something else, right? So we need to understand what is the probability, assuming we're going to assume a coin is a 50-50 if it's a fair coin, which we can usually safely assume in the real world. But Troy, let's go ahead and head back to the script. Maybe we can learn a little bit more about theta and how time impacts our options trade over the passage of time.
Yeah, thanks, Jake. Again, now that we know delta again can give us that correlation of how a option can behave in relation to stock's price, it can also have those other applications. And again, Greeks are a snapshot in time. They're not values that are stationary. They're dynamic. They can move, and so delta can change. If you look at an options delta and you come back to it tomorrow or next week, that delta could be completely different. So again, an options Greeks give us a snapshot in terms of what type of an option it is and how it might behave under certain conditions. With delta out of the way, let's talk about time decay. Time is always working against us. If we are long or we purchase options, time is working for us if we are sellers of options or we are short options. I like to always throw the old adage out there that time keeps on slipping into the future, and it does. It's a constant. You can't change time. So when we're talking about time and how time can either work in our favor or work against us, it's important to know that time decay accelerates close to expiration. What does this mean? This means that time is not linear in terms of how it affects our trades. So if we look, and again, this is a hypothetical example on a hypothetical underlying, we're not really given much context here. If we look at the theta is going to tell us how much daily time decay right now this option is experiencing. So for example, this 97.5 strike call, if we go over here and see our theta, it's 0.0491. This basically means this option should lose all else equal, right? And we know that's an adage that a lot of economists will use, all else equal, meaning if we hold everything else constant, and in mathematics, that's how we solve for multiple variables. We have to hold other things constant and then isolate one thing at a time. And we know that there's usually multiple things are changing at the same time. So this says all else equal per contract, if we're long, we're gonna lose about $4.91 a day. Or if we are short this option, we could gain $4.91 a day purely on the passage of time. Now, again, here's one thing I like to always highlight. If we look at options within about 30 to 60 days, take a look at this graph. This is giving us a hypothetical illustration of how time can decay going towards expiration. It's not a straight line. It goes downward. It's an upside down parabola. It's decaying at an accelerating rate. Take a look at the height here of this 30-day option, right? This height is the options price. That's our y-axis. The options price, again, will go down based on time, all else equal. Again, our x-axis here is time, y-axis is price. If we look at 30 days to expiration, say, all right, on an option, we would have this much time value. Now let's look at 120. Folks, let's do some simple math here. How many times does 30 go into 120? It goes into it 4 times, right? So in 120 days, that's 30 days 4 times. Now, let me ask you this question. If we took this line and we stacked it 4 times, which would be higher, this line or this line? Well, if we stacked, we can see obviously this line's bigger than this line, but if we stacked this 4 times over, once, twice, 3, 4 times, it would be much higher. So the idea is with an option, from an option selling perspective, and this also affects us from the buying perspective as well, we're going to get most of our decay within this short time frame. And if you're looking to, between now and 120 days, you could have done a same 30-day strategy about 4 times, and you're likely to get more more decay from a selling perspective. If you are buying options, just be aware that, hey, a lot of the decay is happening in this time frame. So you got to get the movement that you want or the expectation change that you want because the clock is ticking. So again, we know that option decays at an accelerating rate, and that's usually within that 30 to 45 day window. So as a buyer, we want to be aware that, hey, time is working against us. As a seller, we want to use that knowledge to know, hey, that's going to be typically the most ideal time to sell options is going to be within that 30 to 45 day window. Troy, are you telling me I can't sell a 120 day to expiration option? No, I'm not telling you that. You can absolutely do that. And if there's more premium, if the price is more attractive, you absolutely can sell. What I am telling you is you would, all else equal, get more time decay if you sold a 30-day to expiration option. If you sold it 4 times, assuming you got the price, you didn't get a price movement against you, you would get more time value by doing 30 days 4 times than by doing 120 once. So use that when you're planning your trades. Again, as a seller, we want to time decay is working for us. So we should know when time is working most in our favor, and that's going to be in this area right here, not in this area. Time decay is still working against us. From the long side, it's working for us in the short side, but it's not working for us as much. So let's formally define theta now. So again, theta is understanding as every Greek is, it's a correlation coefficient, which means it tells us how much in contract's value should change based on 1 day's passage of time. So again, if we have a theta of 0.05, and again, usually thetas are displayed in negative values because if you're long the option, if you buy the option, it's working against you. If you are short the option, it's working in your favor. If you have theta of 0.05, your options price, if you were long it, will lose about 5 cents per contract or about $5 per contract for every 1 day's passage of time. So again, let's go back and let's use some practical examples, Jake, and just like you did. If we go to that same Active Trader Pro, we didn't get any ticker symbols in terms of what kind of underlyings we can use. I'm going to use SPY. We could use Apple, whatever we'd like to use again, just for illustrative purposes here. I'm looking at the July 19th expiration. The market's up right now. SPY, which tracks the S&P 500, is up about just shy of 0.5%, about $2.50 per share. It's trading a little bit above 545, about 545 and a third. So if we're looking out about a month or about 32 days, it's not exact, we can start looking at some of these strike prices and say, okay, well, 550, this is the call side, right? And this is our put side, 550, that's above where we're trading at. So the market or the options market expects we're going to be just shy of $5 above 550 or about 555. That's about $10 higher than we are now. If we look and we see, okay, where do we see about $5? Well, if we go to about, and again, give or take a couple pennies here and there, if we go to the 542 strike put, the market expects, hey, I might be willing to buy $5 or so for the 542s because I think it could be $5 lower than 542 by expiration. Now, what do these two contracts have in common? The 542 strike put and the 550 strike call, they're both out of the money. On our chain, you can see we have the shaded regions are the in the money regions. The unshaded are our out of the money regions. When we get very close to the shaded region, we call that at the money because it's very close. It might be slightly in the money, it might be slightly out of the money. But both of these are out of the money contracts. And so if we are buyers of these contracts, we want to get a favorable stock price movement and or we want a favorable expansion in implied volatility to increase the price of our option contract. We want that because we're a buyer. If we were to sell, if I was to sell the 550 call, and typically we would, from a very beginner perspective, we want to be already long 100 shares, just so that would make us have a covered call. It would be a defined risk trade. If we didn't have the shares, it would be an uncovered call sell, which we need a much higher approval level, margin, and it has unlimited risk. So we need to be very, very cautious before ever doing that. From the put side, if we are a seller of the 542 put, that means we potentially might be obligated to buy 100 shares of SPY at 542. We, from a beginner perspective, would want to make sure we have an adequate cash balance. If we don't, it would potentially incur a margin loan. We would need, again, a higher approval level, and we might not want to take on that much risk. But if we are a seller, if I sell either the 542 or the 550 strike call, if the ETF goes nowhere, both trades will actually benefit because the option will begin to lose value. How much value? Well, just like Jake showed us, we can, on our option chain, we can add our, Greeks. For example, I've added Delta, Theta. We haven't talked about Vega yet. We're going to talk about that in a moment. I'll have Jake walk us through what Vega is. But if we look at a Theta, my 550 strike call has just shy of 10 cents, about 9.93 cents per share. So if I sell this contract, I would expect around each day, I would profit about $10. If I sell this 542, assuming there's no price movement, this Theta is a little bit higher. There's a little bit of a skew there. So I would profit about $11 per day if there's no stock movement. Now, again, if we sell the 550 strike call and the the ETF starts going much higher, this option would start increasing in value and that trade would start working against us. If we were to sell the 542 put and the ETF starts substantially going lower, this option we would expect to gain value and that trade would start to work against us. So again, Theta is giving us in a vacuum, assuming everything else equal, how much time is either working for us or working against us. Again, if we are a seller, we like time decay. Time decay is how we make money as a seller. If we are buying options, we need an aggressive stock movement or we need a substantial change in the market's expectation for where a stock or an underlying could be between now and the time to expiration. So speaking of expectation, let's talk a little bit more about volatility. Jake, why don't you walk us through, if you don't mind, Vega and telling us a little bit about how that can tell us how an option can behave with changes to implied volatility.
Yeah, Troy, like you said, Vega is going to be talking about volatility and how our options trade will adjust over time as a result of that volatility assumption. So volatility is the strange part. I like to think of it in simplest terms as the expensiveness of an option. The higher that implied volatility, the more expensive the option is being implied to be. In other words, people think the stock is going to move by a lot. That's what they are implying by the prices they're paying for the option currently. If that's the case, well, how do those changes play out? Just like we saw on previous slides, low volatility, less expectation for movement, less perceived risk. It's all kind of moving in tandem. And as a result, you would also expect to see smaller overall prices for the options contract. Whereas when we have high volatility, more movement expected, that's where we're going to instead see now a higher perception of risk existing in the portfolio or in that trade at that moment. So that's a lot to wrap our heads around. We'll try and make this very approachable as we work through the duration of the presentation. The first thing is, like I mentioned once before, when you look at a volatility number, it will say 10% or 25% or some percentage number. That volatility is measured out and tells us something about an annualized percentage term. Even though your option might expire next Friday or 3 weeks from tomorrow or some time frame into the future, nonetheless, the volatility will always be quoted on an annualized term. That's good because that helps us be able to compare one option against another, both on the same stock and on other stocks, regardless of expiration date, price, the stock price itself, and other factors. All of that's already been considered in calculating 10% of $100 is $10. And so you would expect that the stock would be somewhere between $90 and $110. $10 below, $10 above your current price, looking 1 year into the future. And when we say expectation, we're giving it about a 2/3 probability, 68% or so, that it's within that range a year from now. That's a big range. And you'll notice that it's balanced. It could be $10 below or $10 above. Whereas you may be expecting exclusively the upwards version or exclusively the downwards version. Annualized percent and volatility is looking at this in an unbiased way. It's saying it could be either direction, but the price involved here implies this large of a move. That's why we say there's no bias for direction when we measure it. But when we look at volatility, we actually need to clarify, because there are two main types of volatility that we talk about in the finance world, especially about options. There is historical volatility, whose name implies, yes, that we're talking about history, stuff that already happened, the past. This is what the stock did. It uses, therefore, the actual historical price data over a specific time frame. And we can measure that. You do that by taking a look at the standard deviation, if you remember your statistics classes. So you're going to measure that out over some period of time, and that will include a certain number of, crucial fact, trading days. So an HV of 20, a historical volatility of 20, looks back over the last 20 trading days, or approximately 4 weeks, or you might call that 1 month. Whereas implied volatility is going to be that output from our options pricing model saying this is how much option traders are currently implying about the price. You have to calculate that from the current options contract's price. And therefore, it's telling us about expectations of volatility as measured by what option traders are doing. I don't know what Apple or SPY or anything else out there in the market is going to be worth a month from now. But if I look at the options market, I can at least understand what other traders are willing to put their money towards. They say, all right, I'm buying a lot of these calls or these puts or of both, and the prices for those options change as a result, showing us an increase in an expectation for volatility. I still don't know which direction it's going to be, but I know that there is additional concern building up in that security. You'll notice that that tends to be the case as we approach an earnings announcement, or if it becomes uncertain how a certain product will impact the market or not. If you're looking at a biotechnology or pharmaceutical company and they're approaching an FDA approval moment, you will notice there's a lot of expectations for volatility. We don't know if it'll be good. We don't know if it'll be bad, but we know there's reason to expect that the stock may move in a big way. But since we are looking into the future, instead we're going to use calendar days. We don't need to look backwards and only measure the days where the stock price actually traded. Now we're going to look forward. So an IV30 is going to look 30 days or approximately 1 month into the future and would be equivalent to the HV20, even though it's a different number. Since they're measuring a different thing, you're going to use the HV20 to compare against IV30. And when we take a look at them graphed out over time, here we have two lines. The orange or yellowish line here is the implied volatility, and the blue line is instead the historical volatility. And you'll notice that sometimes, like this period from December through the middle of January, they both rose together sharply. But then at other points, there is a strange deviation, like right here at the start, where the blue line drops and drops by a lot. Or right here, where the implied volatility line drops and drops by a lot. In fact, if we focus on the implied volatility line, we notice that there is one drop right here in the middle of July. 3 months later, a big drop in October. 3 months later, a big drop in January. 3 months later, a big drop in April. That is the type of drop-off that is commonplace immediately after an earnings report. And since those happen every 90 days, they predictably show up on almost every stock chart almost all the time, almost being an important additive in that sentence. But earnings reports are certainly a situation in which there is something that's likely, quite possible, to encourage some change in that pricing. We don't know if it's going to be good news or bad news, but we know that it's likely to be news that people care about. And that's why we look at this event risk as we measure it out. But nonetheless, that does not necessarily mean that you can always profit. Anything that's predictable ought to be profitable. However, here, the reason the implied volatility drops is because the stock price may move. For example, notice this occurrence here in January, where implied volatility predictably dropped from way up here to way down here. That makes sense, right? We're no longer implying this about the future because it just became the past. Now the information is known. Good, bad, or ugly, it's out in the open. And it turns out it was important to the stock price because suddenly our blue line, the stuff that actually happened in the stock, rocketed higher. In other words, suddenly the stock did move by a lot. So observing these changes in implied volatility and how the stock price moves does result in a big change for us as traders as we're trying to develop and understand the changes over time in our options trade. Now, the variable, the Greek term that we use to quantify this is what we call vega. And vega is going to tell us if implied volatility goes up or goes down, how does that change my options price? And the short answer is it can change your options price substantially. For example, in this example, the option has a 0.05 vega, meaning if the implied volatility changes from its current value down by 8%, you would see -8 times 0.5 times 100, giving us $42 change per contract. Now notice $42 or 42 cents, we could say, compared to our current value at $2.83, that's like 20% of the overall value of the contract change simply as a result of implied volatility adjustment. And folks, if you're wondering, is an 8% change in implied volatility reasonable as a result of the passage of an earnings announcement? Absolutely. If we glance at this previous chart one more time, we were going from 40% implied volatility to somewhere in the mid-20s. That was over 10% on this one, and it can be much more extreme. But in this case, that change and that change alone resulted in a 20% change in the value of the contract. So if you think that Trading options is just like trading stock. I hope that this slide was enough to convince you that no, there is more that you simply must consider. You must have an expectation in regards to the stock price direction. Is it going up? Is it going down? Is it going sideways? Whether or not you have a conviction in one direction or not, your trade has a conviction one direction or not. Next, you must have some thought in regards to time. Troy, you're right. It keeps on slipping into the future. Well, folks, nonetheless, you have to decide, is that passage of time worth the risk involved? The opportunity for profits, the risk of loss. That passage of time is a one-way road, and we need to be prepared for it. Next, you need to have some understanding or expectation regards to volatility. Is the volatility currently very high? Do you have reason to expect it will increase or will decrease? Will that hurt or will that benefit your particular option strategy? The hour has already slipped away from us here, folks. I've kept you 2 extra minutes. Troy, are there any other closing thoughts that you'd like to wrap us up with as we close out the hour?
Yeah, at the end of the day, I think that the takeaway here again is to have a plan, right? We want to know the option pricing inner workings because it can help us with planning a trade. We always like to say, form your outlook first and then try to decide what strategy is going to best trade my outlook, right? There's nothing wrong with saying, hey, I really like doing covered call trades. I really like buying calls or I really like buying puts. Just make sure it needs to match your outlook. If you are bullish, you should not be buying puts. If you are very bearish, you should not necessarily be doing a covered call because it's a neutral to slightly bullish type of trade. So make sure you have a plan. Make sure you understand what are the risks to my trade, right? Not only we need to think about what can work for us, what can work out well, but what could work against us. We need to constantly be able to reassess and say, okay, what was my risk reward? Am I doing something that's a little bit higher probability? Maybe it's a slightly lower payout strategy versus is it a lower probability strategy that has a higher payout potential? There's pros and cons of doing both. There's a practical tool called the profit loss calculator. We didn't really have time today, but it can really help us once we pick a strategy. So we form an outlook based on our own analysis, whether it's technical, fundamental, something else. We then can pick a strategy and then we can evaluate it using a tool like the profit loss calculator, understand our risk reward potential and make sure we are comfortable before placing the trade. Once we place the trade, we can monitor and reassess if anything in our outlook changes or potentially even close the trade and manage risk if it turns out, hey, our outlook was wrong, whatever we were expecting to happen, it's not happening. We now need to play defense and protect ourselves. So again, with options, we can trade a lot of different outlooks. You can go long a call, you can go long a put, you can do something like a covered call or sell a cash secured put. So you really now, if you understand both sides of the market, you have a lot of flexibility to trade different outlooks on many different underlyings. That's only going to give you more flexibility in terms of trading markets and giving yourself the highest likelihood of being successful as a trader. So thank you so much for joining us, everyone. Be sure, if you haven't already, to check out fidelity.com/coaching. Check out some of our other sessions. We have something for everyone. We have the daily market briefings if you want to stay in the know with what's happening in the markets. If you need some additional option educational content, we have lots of other option classes and courses on specific aspects of options. We also do other content in terms of charting, fundamental analysis, you name it. So we hope to see you in another session again soon. And Jake, thanks so much for joining me today. Take care, everyone. Have a good rest of your afternoon, good rest of your day. We hope to see you again soon.